Something has shifted in the financial markets, and if you're watching this video, you probably already sense it. The indicators that many of us have been monitoring for months, even years, are no longer theoretical. They're materializing in real time across global currency markets, commodity exchanges, and central bank balance sheets. This isn't about panic. This isn't about making rash decisions based on fear or excitement. This is about understanding what's happening beneath the surface of financial markets, particularly in silver, and why this moment requires your careful attention. Whether you already hold the asset or you've been watching from the sidelines, I want to speak to you today as someone who's navigated multiple market cycles, who's seen bubbles inflate and burst, who's watched disciplined investors build wealth while others chased headlines into oblivion. What we're experiencing right now in the silver market isn't new, but the specific conditions surrounding it, the monetary pressures, the structural supply constraints, the industrial demand profile, these are converging in ways we haven't seen in decades. If you're already positioned in silver, you need to understand why your thesis is being tested right now and what that actually means for your long-term strategy. If you're not yet involved, you need to understand why this asset continues to surface in conversations among serious investors who typically avoid commodity speculation. Let me be direct with you. This video is not going to give you a price target for next week or next month. It's not going to promise you generational wealth if you act immediately. What it will do is walk you through the structural forces reshaping monetary reality, explain how silver fits into that picture, and give you a framework for thinking clearly during a period when most people will think emotionally. Let's start with what's different now compared to 6 months ago, a year ago, or even 5 years ago. The most significant change isn't happening in silver itself. It's happening in the underlying foundation of our monetary system. We're watching the slow-motion repricing of confidence in fiat currency systems. And that repricing accelerates every time debt levels reach new extremes, every time inflation proves stickier than central banks predicted, every time the gap widens between official narratives and lived financial reality. Here's what changed recently. The divergence between paper silver markets and physical silver markets has widened to levels that market veterans find remarkable. We're seeing premiums on physical metal that suggest real supply tightness, while futures markets continue trading patterns that seem disconnected from physical availability. This isn't conspiracy. This is basic market structure under stress. Industrial demand for silver hasn't collapsed despite economic uncertainty. In fact, it's remained resilient because silver sits at the intersection of technologies that aren't optional anymore. Solar panels, electric vehicles, 5G infrastructure, medical applications. These aren't discretionary purchases that vanish during economic slowdowns. They're part of infrastructure build-outs that governments have already committed capital toward, regardless of broader economic conditions. Meanwhile, primary silver mining hasn't expanded to meet this demand profile. Mining is a long-cycle business. New mines take years to develop, require enormous capital investment, and face regulatory hurdles that have only intensified. The easy silver has been extracted. What remains requires higher prices to justify extraction costs. We're not seeing a supply response because the price signal hasn't been sustained long enough for producers to commit billions in capital expenditure. On the monetary side, something subtle but important has happened. Central banks globally have been accumulating gold at rates we haven't seen since the early 1970s. They're not broadcasting it. They're not explaining their reasoning in press conferences. But the actions speak clearly. The world's monetary authorities are quietly diversifying away from pure fiat reserve structures. Silver doesn't move identically to gold, but it moves in the same direction when monetary confidence erodes. You've probably noticed that inflation, despite central bank efforts, hasn't returned to the 2% targets that became gospel over the past 2 decades. Whether you call it inflation or currency devaluation depends on your perspective, but the effect is identical. The purchasing power of cash savings has declined measurably. This matters for silver because throughout history, tangible assets have served as insurance against currency degradation. The average person, even the average investor, fundamentally misunderstands what silver is and why it matters. Most people think of silver as an investment, something you buy, hoping it goes up so you can sell it for more dollars later. This framing immediately puts you in the wrong mindset. Silver isn't primarily an investment vehicle. It's a form of monetary insurance and a productive industrial metal. Understanding this distinction changes how you think about position sizing, time horizon, and what success actually looks like. When silver moves violently, as it has in past cycles, people assume it's speculation driving the price. But look deeper. Speculative froth always appears during the late stages of moves, but the foundation is usually built on legitimate supply-demand imbalances or monetary dysfunction. The speculation amplifies what's already happening structurally. Another widespread misunderstanding. People think silver moves because of retail investor sentiment. They see online forums buzzing about silver and assume that's the driving force. But retail investors, even collectively, represent a tiny fraction of the silver market. What matters far more: industrial consumption, ETF flows, institutional positioning, mining production rates, and central bank monetary policy. Retail enthusiasm is usually a lagging indicator, not a leading one. Many investors also fail to understand the gold-silver ratio and why it matters. When silver becomes historically cheap relative to gold, it signals either that industrial demand has collapsed, which we're not seeing, or that silver is undervalued relative to its monetary metal peer. Throughout history, extreme ratios have eventually corrected, sometimes violently. We're currently sitting near historically elevated ratios, meaning silver is cheap in gold terms despite elevated industrial demand. Perhaps the biggest misunderstanding: people think they've missed the move whenever silver rallies. They see price rise 10 or 15% and assume they're late. But in actual commodity bull markets, the kind driven by structural imbalances rather than speculation, the move unfolds over years, not weeks. The early stages feel like you're late because you're programmed by recent market history to expect quick reversals. Real structural moves don't reverse quickly. They grind higher, pull back, consolidate, then grind higher again, slowly building conviction among a broader investor base. Let's step back and look at how markets have historically behaved when conditions similar to today emerged. The 1970s provide the most referenced parallel, and for good reason. That decade saw silver move from roughly $1.50 to nearly $50 at its peak, though the final spike was driven by extraordinary circumstances that aren't repeating today. But before that blow-off top, silver spent years grinding higher as investors gradually lost confidence in currency stability. Inflation proved persistent despite repeated government assurances. Debt levels concerned thoughtful observers. The dollar's link to gold had been severed, creating uncertainty about what backed currency value. What's instructive isn't the peak price, it's the pattern. Silver didn't move straight up. It rallied, consolidated for months, rallied again, pulled back sharply, then ultimately continued higher. Investors who tried to time perfect entries and exits mostly failed. Those who accumulated positions during the consolidations and held through volatility generally succeeded. The late 2000s and early 2010s offer another reference point. Silver moved from below $10 to nearly $50 between 2008 and 2011. Again, the final move was excessive and corrected sharply. But the foundation was built on legitimate concerns: quantitative easing programs that expanded central bank balance sheets by trillions, near zero interest rates that penalized savers, and growing questions about sovereign debt sustainability. What happened afterward is equally instructive. Silver corrected from $50 to below $14, wiping out speculative positions and discouraging an entire generation of investors. Many concluded that silver was a failed investment and that the monetary collapse narrative was wrong. But here's what actually happened. The monetary pressures never resolved. They were temporarily masked by coordinated central bank intervention and deferred through additional debt accumulation. The underlying conditions that drove silver higher initially didn't disappear. They just moved to the background for a decade, while confidence in central bank omnipotence grew. Now we're watching those same pressures resurface, but with a crucial difference. Debt levels are exponentially higher. Central banks have less room to maneuver. The political will to impose austerity has evaporated, and industrial demand for silver has grown substantially due to technological shifts that didn't exist in previous cycles. Every major commodity cycle throughout modern financial history has featured a common pattern: long periods of price suppression followed by explosive moves that overshoot fundamentals before correcting. The duration of suppression influences the magnitude of the eventual move. Silver has been range-bound or declining for over a decade in real terms. The spring has been compressed for an unusually long time. Let's talk about the bigger economic picture without getting lost in jargon. Start with debt. The United States federal debt now exceeds $36 trillion. State and local governments carry additional trillions. Corporate debt has exploded. Consumer debt has reached record levels. This matters because debt is simply future consumption pulled forward. It must eventually be repaid, restructured, or inflated away. There are no other options. Repayment requires economic growth that exceeds the debt growth rate. We're not seeing that. Restructuring means default, which destroys confidence in credit markets. That leaves inflation as the politically preferred path. It's the quietest form of default, the one that most people don't fully understand until purchasing power has already declined substantially. When I mention inflation, I'm not talking about the consumer price index number released monthly by government agencies. I'm talking about monetary inflation, the expansion of money supply relative to productive economic activity. Whether that shows up in consumer prices, asset prices, or both depends on where the newly created money flows. But it shows up somewhere. Interest rates represent another crucial force. For over a decade, rates were held at artificially low levels to support debt refinancing and encourage borrowing. This created an environment where nearly every asset became expensive because the discount rate for future cash flows was pushed to historic lows. When rates finally began rising to combat inflation, it exposed how dependent the entire financial system had become on cheap money. But here's the trap. Rates can't stay elevated indefinitely without causing government debt service to consume enormous portions of tax revenue. Every percentage point increase in interest rates adds billions to federal interest payments. Eventually, fiscal math forces rates back down or forces monetary expansion to manage the debt burden. Either path diminishes currency purchasing power over time. Currency pressure is the logical outcome of these forces. When investors globally begin questioning whether holding dollars or euros or yen makes sense compared to tangible assets or alternative currencies, you get gradual repricing. It doesn't happen overnight. It happens through small shifts in central bank reserve allocations, through increased commodity buying from emerging markets, through wealthy individuals diversifying into hard assets. Silver sits at the intersection of these pressures because it functions as both a monetary metal with thousands of years of history and an industrial commodity essential to modern technology. When currency confidence erodes, monetary demand for silver increases. When governments push infrastructure spending to support economic growth, industrial demand for silver increases. These two demand streams can reinforce each other in powerful ways. Market cycles themselves follow psychological patterns that are remarkably consistent. Early in cycles, few people believe the move is real. They expect immediate reversals based on recent experience. As the cycle matures, more investors participate but remain nervous, constantly looking for exits. Late in cycles, euphoria dominates, everyone has a story about profits, and caution is dismissed as pessimism. Finally, bubbles burst, when the last skeptics capitulate and buy at peak prices. Understanding where we are in this cycle matters enormously. By most measures, we're still early. Mainstream financial media rarely discusses silver positively. Most retail investors don't own any. Institutional portfolios carry minimal exposure. These are characteristics of early cycle positioning, not late cycle excess. Let me share how serious investors are thinking about this environment, because it's dramatically different from how most people approach markets. First, they think in probabilities, not certainties. They recognize that no one knows exactly when or how quickly silver might move higher, but they assess that the probability of significant upside over a multi-year period exceeds the probability of permanent capital loss, especially when position sizing is appropriate. This is risk-reward thinking, not prediction. Second, they think in terms of portfolio insurance rather than speculation. A serious investor might allocate 5 to 15% of their portfolio to precious metals, not because they expect 10x returns next year, but because they want asymmetric protection. If monetary conditions deteriorate significantly, that allocation could preserve purchasing power even if other assets struggle. If markets remain stable, the opportunity cost is limited because the position is appropriately sized. Third, disciplined investors scale into positions rather than trying to time perfect entries. They recognize that catching exact bottoms is nearly impossible, and that trying to do so often means missing the bulk of important moves. They might buy some silver at current levels, wait for a pullback to add more, and continue averaging in over months or quarters. This removes the psychological pressure of needing to be right about timing immediately. Fourth, they completely ignore short-term price volatility. Silver is among the most volatile, widely traded commodities. It can move 5% in a day without any meaningful news. Investors who check prices constantly and react emotionally to normal volatility inevitably make poor decisions. Those who set positions and check quarterly tend to maintain discipline through inevitable drawdowns. Fifth, sophisticated investors separate physical metal from paper exposure. They understand that owning physical silver stored securely provides different characteristics than owning an ETF or mining stocks. Physical metal can't go to zero, carries no counterparty risk, and provides genuine portfolio diversification. Paper vehicles offer liquidity and convenience, but introduce risks that physical doesn't carry. A thoughtful approach often combines both. Sixth, they educate themselves continuously. They read mining company reports to understand production trends. They follow industrial demand data from legitimate sources. They study monetary history to understand how similar situations evolved previously. They don't rely on social media posts or YouTube comments for their information foundation. Most importantly, disciplined investors maintain emotional control. They don't get excited during rallies or despondent during corrections. They understand that the path of any asset is never linear, that drawdowns are inevitable, and that conviction comes from understanding fundamentals rather than price action. When silver pulls back after rallying, they review their thesis. If fundamentals haven't changed, they remain patient or add to positions. They don't panic sell. If you're already positioned in silver, this moment requires clear thinking about your strategy and expectations. First, understand that your thesis is likely being validated, not contradicted, even if price action feels frustrating. The divergence between paper and physical markets, the sustained industrial demand despite economic uncertainty, the continued monetary expansion by central banks, These are precisely the conditions that originally justified the position. Short-term price volatility doesn't change structural realities. Your primary risk right now isn't market risk, it's emotional risk. After holding through periods of consolidation or correction, human psychology creates powerful urges to sell when things finally start moving. You feel vindicated, you want to lock in gains, you fear giving back profits. This is exactly when selling often proves premature. The biggest moves in commodity markets happen after most people have already exited. Consider your position size honestly. If your silver allocation causes you to check prices multiple times daily, or lose sleep over volatility, you're oversized regardless of what the textbooks say about appropriate allocation percentages. Portfolio management is as much about psychological sustainability as mathematical optimization. If you need to reduce size to maintain emotional discipline, do it. Better to hold a smaller position comfortably than a larger position that forces poor decisions. Think carefully about your time horizon. If you allocated to silver as a multi-year position based on structural trends, nothing about near-term price moves should change that plan. But if you originally intended to trade momentum and you're now holding through drawdowns, you've shifted strategies without acknowledging it. Be honest about whether you're investing or trading, because the appropriate behaviors differ dramatically. For those holding physical metal, your considerations differ from those holding paper. Physical silver provides the maximum security and minimum counterparty risk, but it's also the least liquid and carries storage considerations. If you need to access capital quickly, physical metal is suboptimal. Your physical position should represent the portion of your silver allocation that you truly don't need to touch for years. If you hold mining stocks or ETFs, understand that these move more violently than physical metal, often with higher beta in both directions. During genuine bull markets, miners can outperform the metal substantially. During corrections, they typically decline more sharply. This leverage cuts both ways. Your tolerance for volatility should determine what percentage of your silver exposure comes through paper vehicles versus physical. One crucial point: if your silver position was meant to be insurance, protection against currency devaluation or financial system stress, then measuring its success by short-term price appreciation misses the entire point. Insurance isn't supposed to generate profit. It's supposed to be there when other things go wrong. The fact that you haven't needed your silver yet doesn't mean it was a poor decision. It means the disaster you were insuring against hasn't fully materialized. For those watching without current positions, this environment presents both opportunity and danger, and distinguishing between them requires clarity. Opportunity exists because structural fundamentals appear aligned in ways that don't happen frequently. Supply remains constrained, industrial demand remains strong, and monetary conditions continue favoring tangible assets over paper currencies. Historically, these conditions have eventually driven significant price appreciation. The window during which silver remains unloved by mainstream investors may be closing, but danger exists in equal measure because entering positions emotionally, without education or with inappropriate size, creates catastrophic risk. More wealth has been destroyed by people buying the right assets at the wrong time, in the wrong way, for the wrong reasons, than by any other investment mistake. Silver is particularly brutal to inexperienced investors because its volatility shakes out weak hands before the real moves materialize. If you're considering a position now, the worst possible approach is going all in immediately based on someone else's conviction. The right approach involves education first, gradual entry second, and emotional preparation third. Spend real time understanding why silver matters beyond price charts. Read about monetary history, supply dynamics, industrial applications. Build genuine conviction rather than borrowed excitement. Start small. If you've never owned precious metals, allocating half your net worth to silver because you watched convincing videos would be reckless, begin with 1 or 2% of your portfolio. Experience the volatility firsthand with money you can genuinely afford to see decline temporarily. Learn how you respond emotionally to price swings. Adjust your position size based on that self-knowledge. Prioritize physical metal for initial positions, even though it's less convenient. Owning physical silver teaches you immediately that this isn't a trading vehicle. The friction of buying, storing, and eventually selling physical metal naturally encourages appropriate time horizons. You're far less likely to panic sell physical silver during a correction than paper silver you can liquidate with a mouse click. Ignore the noise about missing the move or being late. Every commodity cycle features numerous opportunities to enter at reasonable prices, even after the move has begun. The 1970s silver bull market lasted nearly a decade with countless entries that proved profitable over multi-year periods. The 2000s bull market lasted 3 years with multiple consolidation phases that offered entry points. You're not late if structural conditions remain favorable and mainstream adoption hasn't occurred. Except that you will not buy the exact bottom. If you wait for the perfect entry price, you'll wait forever. If you demand certainty before acting, you'll never act because investing always involves uncertainty. The goal is reasonable entry over time, not perfection. The most important thing to understand if you're considering silver now, you must separate education from action. Learn first, without feeling pressure to immediately deploy capital. Markets will still be there next week, next month, next quarter. But the decisions you make in haste, without understanding, almost always prove costly. Taking 2 months to study silver thoroughly before buying will serve you far better than buying today based on incomplete understanding. Now let's discuss the behaviors that consistently destroy capital, because knowing what to avoid is often more valuable than knowing what to do. Do not react emotionally to daily price movements. Silver will have days where it drops 3% for no apparent reason. It will have days where it spikes 5% on headlines that prove irrelevant. Each time your psychology will scream at you to do something, to sell, to buy more, to check your account again. Resist this completely. Daily price movements contain almost no useful information for long-term investors. They're noise, and reacting to noise is how disciplined strategies turn into trading disasters. Do not chase momentum. When silver finally begins moving sharply higher, your instinct will be to buy aggressively, fearing you're missing out. This is precisely backward. The time to buy aggressively was during the consolidation or decline when it felt uncomfortable. When it feels exciting and everyone's talking about it, you're usually closer to a correction than a beginning. Momentum is profitable for experienced traders with strict discipline. For everyone else, it's a trap. Do not use leverage or margin to amplify your position. Silver's volatility makes leverage extraordinarily dangerous. What looks like easy money when prices rise becomes catastrophic when they correct. The silver market has bankrupted countless traders who were ultimately right about direction, but couldn't survive the drawdowns because leverage forced liquidations. If you can't afford the position with cash, you can't afford the position. Do not blindly follow online personalities or social media hype. The internet is filled with people claiming to have special knowledge about silver, sharing price predictions with false precision, creating urgency where none exists. Some are well-intentioned, but wrong. Others are manipulative, building audiences to monetize through affiliate arrangements or paid promotions. Your financial future is too important to outsource to strangers on the internet. Build your own understanding. Do not neglect the rest of your financial foundation. I've seen people allocate to silver before establishing emergency savings, before paying off high-interest debt, before maxing available tax-advantaged accounts. This is backwards. Silver is a component of a complete financial strategy, not a substitute for financial basics. If you don't have 6 months of expenses saved, if you're carrying credit card debt, if you're not contributing to available retirement accounts, those take priority over commodity positions. Do not expect silver to solve problems it can't solve. It won't generate income. It won't make you wealthy next month. It won't protect you from poor financial decisions in other areas. It's insurance against currency devaluation and a speculation on supply-demand dynamics, nothing more and nothing less. Misunderstanding what silver can and cannot do for your financial life leads to poor position sizing and inappropriate expectations. Do not ignore tax implications. In many jurisdictions, precious metals carry specific tax treatment that may be less favorable than other investments. Understand the rules in your location before establishing positions. The difference between long-term capital gains and collectibles tax rates, for example, can significantly impact your actual returns. Professional tax guidance specific to your situation is worth the cost. Most importantly, do not mistake understanding for wisdom. You can read everything available about silver, understand every macroeconomic argument, and still be wrong about timing. Humility about what you can't know, which is most things, should inform position sizing and risk management. Confidence in your thesis is valuable, but overconfidence is deadly. As we move forward through this financial environment, your success will depend less on perfect timing and more on consistent discipline. Continue educating yourself, but focus on quality sources, mining company financial reports, industrial demand data from trade organizations, central bank balance sheets, historical market analysis from respected researchers. These build genuine understanding. YouTube videos, Twitter threads, and Reddit forums can supplement education, but shouldn't form its foundation. The signal-to-noise ratio on social media is extremely low. Monitor your own psychology more than you monitor price charts. How do you feel when silver drops 10% over a few weeks? Are you panicking? Are you calmly reviewing your thesis? Are you looking to add at lower prices? Your emotional responses reveal whether your position size is appropriate and whether your time horizon is realistic. Self-awareness is more valuable than market awareness for long-term investors. Maintain perspective on time horizon. If you've allocated to silver based on structural factors that unfold over years, then monthly or quarterly price action is irrelevant. Yet most people obsess over short-term moves while claiming long-term orientation. The disconnect between stated strategy and actual behavior is where most mistakes occur. If your thesis requires years to play out, behave accordingly. Check positions quarterly, not daily. Stay flexible without being reactive. There's a crucial difference between rigidity and discipline. Discipline means sticking to your strategy despite volatility. Rigidity means refusing to adjust when facts change. If legitimate developments occur that contradict your original thesis, maybe industrial demand collapses, maybe mining supply surges dramatically, you must be willing to reassess. But distinguish between genuine thesis-breaking developments and normal volatility. Build redundancy into your approach. Don't keep all your metal with one storage provider. Don't hold exclusively physical or exclusively paper. Don't concentrate all commodity exposure in silver alone. Redundancy reduces specific risks without abandoning the overall strategy. It's the difference between conviction and recklessness. Connect with others who think long-term, not those who trade daily. The community you surround yourself with shapes your behavior more than you realize. If you're constantly exposed to traders discussing day-to-day price action, you'll unconsciously adopt shorter time horizons. If you connect with investors who discuss multi-year themes and structural factors, you'll maintain more appropriate perspective. Remember that cycles reward patience. The most profitable positions in any commodity cycle belong to those who establish positions early when it's uncomfortable and hold through volatility until genuine excess appears. We're not in the excess phase. We're not seeing jewelry stores advertise silver buying parties. We're not seeing mainstream financial advisors recommend 5% portfolio allocations to silver. We're not seeing celebrities discuss their silver holdings on talk shows. These are signs of late cycle excess, and they're absent. Let me leave you with the framework that matters most as you navigate this environment. Financial markets are not casinos where random events determine outcomes. They're complex systems where structural forces, human psychology, and policy decisions interact in predictable patterns over time. Silver is not a lottery ticket or get-rich-quick scheme. It's a tangible asset with thousands of years of monetary history and modern industrial applications, currently trading in an environment where monetary pressures and supply constraints are building simultaneously. You don't need to predict exact prices or perfect timing to benefit from understanding this situation. You need to assess probabilities, manage risk appropriately, maintain emotional discipline, and think in terms of years rather than weeks. These are skills that transfer to every aspect of financial life, far beyond silver specifically. The crisis I mentioned at the beginning isn't coming. It's here. But crisis doesn't mean catastrophe. It means decision point. The decisions you make now about education, about position sizing, about time horizon, about emotional discipline, these will determine whether this period represents opportunity or regret in your financial life. For those already holding silver, your challenge is patience during volatility and conviction during doubt. The structural factors that originally justified your position haven't disappeared. They've intensified. Trust your thesis, but verify it continuously through education rather than price action. For those considering positions, your challenge is education before action and discipline in sizing. The opportunity is real, but only for those who approach it with respect for what they don't know and humility about timing uncertainty. Start small, learn continuously, and scale over time. For everyone watching, the real value of this moment isn't whether silver rises 20 or 50% over the next few years. It's the lesson that understanding cycles, maintaining discipline, and thinking independently matter more than following crowds or reacting to headlines. These principles apply to every investment decision you'll make for the rest of your life. The financial landscape is shifting beneath our feet. Currency confidence is eroding slowly but steadily. Debt levels continue compounding. Central banks face impossible choices between inflation and default. In this environment, tangible assets with real utility have historically provided protection that paper assets cannot. Stay informed. Stay disciplined. Stay thoughtful. The investors who build lasting wealth through market cycles aren't those with the highest IQ or the best information. They're those with the emotional control to execute strategies that make sense even when they feel uncomfortable, and the patience to hold through volatility that shakes out everyone else. This moment demands your attention not because you need to panic, but because you need to understand. And understanding, combined with appropriate action and endless patience, is how thoughtful investors turn macroeconomic shifts into long-term financial security. Thank you for your time and attention. Use this information wisely.